Average cost means the total output divided by the quantity. There is a respective area. That means there is a respective slot that we have allocated in terms of the total fixed cost and the total variable cost, the marginal cost. This is the most interesting factor that we have to talk in terms of economics. Marginal cost will always cut the average total cost from the bottom. Good morning and welcome to the second session in Unit 5 in Business Decision Theory, where we are going to speak about the cost analysis. And this is going to be the second part of our cost analysis, continuation to the previous one where we were talking about the different kinds of cost. So we are now going to look into the average total cost. Now, we all know that average cost means the total output divided by the quantity. So now we are going to go into the average total cost, which is also called as the unit cost. So what is the production cost per unit value? This is very, very important for all of us to know. So average total cost are the key cost in the theory of firm because they indicate how efficiently scarce resources are being used. Now, this is a very important concept where we have to understand the factors clearly. Why? If you're looking into a system today, the system has got a lot of inputs. That is, the organization typically tries to get raw materials from different places altogether. Not all the raw materials are of equal value. Some of the materials might be costly. Some of them might be cheaper in nature. But what happens for an industry is that when they want to source some materials, it is not going to be available easily. So they have to think twice before they start using a particular material in what levels and in what quantity. Now, for example, let us look into the automobile sector itself. Due to the recent pandemic scenario, most of the automobile companies have gone completely short in terms of the chip. That is the semiconductor chip which is used in the modern technology, in the engines in the car altogether. So now what is happening is that if somebody would have already predicted and would have told the automobile companies that you need to invest more time, money on the semiconductor chip rather than just building up the automobiles, definitely they would have saved a huge amount of money. So today what is happening is that every single resource that we are using in terms of production has got this inherent value. Now, unless and until you understand the inherent value and start producing it, we will not be able to go further. We will find it that this becomes difficult day by day. So what we tend to do is that we start understanding that somehow or rather the resource utilization has to be taken care of. So most probably what we tend to do is that we tend to understand the efficiency process altogether. We first try to see which resources, how it needs to be used and how well we have to structure it altogether. So what we tend to do is that we tend to understand the average total cost or the unit cost. Let's say that I am going to use steel or aluminium or copper or zinc or any other metal. I'm going to look at the unit cost factor. If the unit cost factor is higher for me, that means that resource has to be very, very carefully used upon. Rather, I would also think in the other manner, can I look in for a substitute altogether because that will bring down my production cost. So in all the industries taking forward, the most important question to be dealt upon is the utilization of resources, how efficient you are in terms of using it. Now followed by the average variable cost of found by dividing the total fixed cost by the output, which we know in most of the cases. So when you see here the average total cost, everybody tends to keep the average total cost in a particular wavelength, in a particular range altogether. They don't want the average total cost to keep on increasing because that might not be a feasible solution, that might not be considered to be a good solution at all. So this is how we will start trying to see that the average total cost comes to a particular level, comes to a particular limitation altogether. Followed by, in the average total cost, we can also see that when we are going to add the factors, when I'm going to talk about the AFC and the AVC. So that means when I'm going to add the average fixed cost plus the average variable cost, that will lead me to the average total cost. This is the basic formula that we are trying to understand. So when you see here, AVC plus AFC is equal to the ATC, the average total cost factor. Now, how does this important for us is that, again, when you see the ATC is again a U-shaped curve. I would like to just go back again to the graph to just show you how it looks like. If you look here in this graph, you are able to see that the average total curve is again a U-shaped curve which is floating in nature, and it is because it takes the form from the AVC curve with the upturn reflecting the honest, the start plot of the diminishing returns of variable. The onset is how when you start getting into the diminishing returns of the variable factor, then automatically it will start increasing. So as an industry today, our major thought process, our major ideology that we have to think in our mind even before stepping into this is how to maintain the cost factors at the lowest level as far as possible. Because we are not interested just in raising up the cost and going back and saying that yes, we have done a fantastic job. The real factor, the real challenge lies in terms of reducing your cost and maintaining an optimum output as far as possible. Now, the next thing is that the areas for total cost. Now, let's look into the areas of the total cost. When I say that, there is a respective area. That means there is a respective slot that we have allocated in terms of the total fixed cost and the total variable cost coming into picture. So how are we going to explain this? How are we going to take it forward altogether? Now, let's try to understand that the total fixed cost and the total variable cost are the respective areas under the average fixed and the average variable cost factor altogether. So what is now going to happen is that we are going to think in terms of an analysis, in terms of a factor altogether. So we are going to take the system altogether to understand how the rotation, how the mechanism works all here. Now, if you see here, this dotted area, we are calling it as the total fixed cost. So you will have the total fixed cost mentioned to this level. That's a particular level altogether. The total variable cost, which is combined this particular area here. Now, when you add these two, you will receive the total cost. So when you add the total fixed cost plus the total variable cost, you will be able to get the total cost function here. So on your x-axis, you will be on your y-axis, you will be taking the cost and revenue, and on the x-axis, you will be taking the output. So when you do a trade-off, you will try to understand what is the cost variation factors that we are trying to do here. So ultimately, the most important thing that I would like to say here is that as much as you can reduce on the total variable cost, the more you reduce on the total variability factor, the fixed cost remains to a certain extent. You are able to achieve an optimum solution in terms of production. So this is what is needed at this particular juncture. You need to understand very, very clearly that this is what we are trying to do in terms of building up the entire system. Followed by the marginal cost. This is the most interesting factor that we have to talk in terms of economics, in terms of the industrial factors altogether. Marginal cost is the cost of producing one extra unit of the output. So now when you look into the graph, you will be able to see that as I keep on producing one unit extra at the regular phases, my marginal cost tends to keep on increasing. It will tend to increase because I'm trying to produce one more extra. I'm trying to go on a production spree altogether by increasing, because I believe that if I can produce one extra, one more, and if I keep on that, the total output will increase. So what happens is that it can be found by calculating the change in total cost when the output is increased by 1 unit. So instead of producing 10 units, if I have to produce 11 units, I need to find out the difference here, as in how much will that 1 unit cost extra. So that is where marginal cost comes into picture, which is a very, very important concept for all of us to understand. The next thing is that marginal cost curve falls briefly first and then rises. That is quite true. Why? Because if you literally see here, initially the marginal cost would fall down like this and slowly it starts increasing. Why does this happen here is because when you start producing, the variability factors are derived. Marginal cost comes from the variable cost and not from the fixed, and are subjected to the principle of variable proportion. So if you ask me, where is marginal cost actually associated with? It is associated with the variable cost. More the variations you are trying to bring in terms of doing the business, in terms of production altogether, then you will start seeing that the variability increases, the marginal cost will also tend to increase. So whenever you are talking about those factors, whenever you want to produce those extra units altogether, definitely there is going to be some sort of push that is going to come into picture. So I would always say that at any given point of time, the most important thing that you need to concentrate, that you need to think about, is the marginal cost factor. The marginal cost tends to keep on increasing over a period of time. Now, the next thing is the significance of the marginal cost. This is very, very important. Why? Marginal cost is quite significant in the theory of the firm for two reasons. One, it's a leading cost curve because the changes in total and the average cost are derived from the marginal cost. So as you tend to go up the production line, as you tend to make any changes, any factorial things here, automatically you will see that the marginal cost will be a significant improvement because you're going to derive it from that particular position. The second thing is that it's the lowest price in the firm is prepared to supply is the price just covers the marginal cost. The lowest price a firm is prepared to supply is the price of the margin. So whenever you are producing something, you will add up to the margin and then sell. So marginal cost is equal to the average price factor. That is the lowest price that you would be likely to sell in the market. But if you are trying to sell something below the marginal cost, then automatically it signifies a loss for you. So the importance of marginal cost is indirectly related to the profit factors very clearly. The more the organization tends to understand this, they will come to know that we have to first cover the marginal cost and then start moving up the order. So at any given point of time, when you start thinking about the marginal cost, you need to understand this factor completely. You are not going to just take it lightly because most of your average factors and your variability factors are directly derived from the marginal factors. So now let's go forward in terms of the ATC and the marginal cost, that is the average total cost and the marginal total cost. Now both of these costs are connected because they are derived from the same basic numerical cost data. Now look at the relationship altogether. They are derived from the same basic numerical cost data. That's what we are looking at. So the general rules that are going to cover is that marginal cost will always cut the average total cost from the bottom. So when you talk about an average total cost curve like this, the marginal total cost will come like this, cut it at the bottom, and you will see that there is an intersection here altogether. So this intersection point is what we have been talking about. The next thing is that when the marginal cost is below the total cost, that is at this this juncture, when it's below the total cost, and the average total cost will be falling. Why? Because marginal cost is also falling, and when it's above, the total cost will also increase. So they are directly related. As the average total cost increases, the marginal cost will also tend to increase, and vice versa. When average total cost decreases, marginal cost will also decrease. So that is where exactly we are trying to understand the relationship factors here. Now, a firm is most productively efficient at the lowest average total cost, which is also where the ATC is equal to marginal cost. So your average total cost, if you can equate it to your marginal cost, that means you have done a fantastic job of making your productivity reach the lowest level in terms of cost, because beyond which, even if you're going to put a 1 rupee margin and sell it across in the market, that's going to be a pure profit for you. So please understand this factor very clearly, that when we are talking about the lowest average cost, which is interlinked to that factor of marginal cost, automatically ATC is equal to the MC factor. That's your marginal cost factor at any given point of time. This is highly important for all of us to understand and take it forward. Now the next thing is that the total cost and the marginal cost that comes into picture. Marginal costs are derived exclusively from the variable cost and are unaffected by the fixed cost. So there's not going to be any impact of fixed cost changes coming into picture. We are not really worried about it, or we are not really bothered about it. The MC curve that you are able to see here is the gradient of the total cost curve, and the positive gradient of the total cost curve exists only because of a positive variable. This is shown below. This is what you are going to see here. If you can see the graph here, you will see that it's a positive gradient altogether from the fixed cost, from what we are trying to derive. So what is here the factor is that the total cost and the marginal cost are an exclusive factor that one has to understand in terms of production ongoing cycles. Now, the next thing is the sunk cost. This is the last type of cost that one has to understand in terms of the business. Sunk costs are those that cannot be recovered even when a firm goes out of a business. So imagine for a while that you are starting a business today. The money that has gone in terms of in starting up the industry, putting up the machinery, doing the foundation, that money cannot be recovered back at any point of time, including the money that has been spent on advertising, marketing, or any machinery installation will have no scrap value. So even if you are going to sell off the entire business, you are going to shut down the entire business, and still you want that you will get some money back from it, you are not going to get it. Sunk cost is something that the cost you have completely foregone, even though if you are out of the business. So sunk costs are considered to be a barrier for entry and exit. Why we say this particular word here is because whenever you want to enter into a business and you want to exit out of the business, you need to do a basic calculation as in how much will it cost for me if I enter, and what will be the loss if I have to shut it down. So the sunk cost will actually determine the nature of business and will give the entrepreneur a clear picture in terms of whether this business is profitable in nature, can we do this business, or is it something that we can avoid it in the long run altogether. So that is why we say that the sunk cost is a very important factor when it comes to making a managerial decision altogether. With this, I come to the end of this particular session. I hope and believe that all the information shared through this session will be of a great benefit and help to you. We shall learn more about business decision theory. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.